Hi there, welcome to Kneppy Invest. Time for another technical update. I try to do one of these or release it every single Sunday. And the theme of today's video is February Mayhem. We have seen the share price of quite a few companies go up or down quite a bit during the past week. Now, we're still in reporting season, so a lot of companies have reported their half or full year results. And a few of the reactions from the market in regards to these results have led to the share price of many companies on the ASX either rising by a lot or falling by a lot. So we'll touch upon a few of those companies, but also a few of the companies I will be featuring in this video have not released their half year or full year results, but interesting things have been happening to those companies. So we'll be touching upon, if I remember correctly, 10 companies in today's video, all ASX listed, and the majority of the companies I'll be looking at aren't big companies either. So we're looking at small caps, mostly small caps, maybe one or two mid caps in today's video, but the majority of companies are small cap companies. So let's have a look at the 10 companies I'll be featuring in today's video. The first 4 companies we'll be looking at include New Century Resources, Avita Medical, Cogstate, and Step One. So if you like your undies, Step One could be the company for you. And then we'll take a look at Platinuum Asset Management, Magnis Energy Technologies. They did a offtake with Tesla, and you would think the share price would take off based off that outtake. The share price initially rose about 20 or 25%, and then absolutely collapsed. Same thing happened with MoneyMe. In fact, they released a really positive trading update on the 31st of January. Share price rose 62% on that day, but the share price is now 20 or 25% lower than the day before they released a positive trading update. So really interesting trading when it comes to MoneyMe. Also have a very first look at Australian Ethical Funds. I do know some people who like this fund just because it's got the name ethical in it, and I don't think personally, I would never buy into a fund just because it's got the word ethical in it, but they've really pushed that ethical theme. And up until a few years ago, this was a highly valued fund on the ASX. And when I say highly valued, I mean in terms of what it was doing, it was way overvalued. And the last 2 companies are law companies, Shine Lawyers, which I think is now called Shine Justice, and Slater and Gordon. Quite a few years ago, Slater Gordon was a $1 billion company. Now it's 80 million. And if you've held Slater Gordon shares over the past 8 or 9 years, you have been highly diluted. Yet they did release some positive results. And quite conversely, Shine Justice released negative results. And we saw the complete opposite to what we saw with Slater Gordon. But the first company I want to look at is New Century Resources. A bit of turmoil happening with that company right now. Yeah, the share price did increase 42% because of a potential takeover from the company's largest shareholder, which is Sibanye Stillwater. They own 19.9% of the company. So let's talk about New Century Resources. What a horrible looking chart. This is probably the sort of chart you want to see if you are a shareholder of a company. In fact, the share price has gone from the top left to the bottom right. We want the complete opposite. We want the shares of a company go from the bottom left to the top right. So shareholders of the company are not happy and have not been happy with the management over the past few years. And that's where steps in the largest shareholder, which is Sibanye Stillwater, which is a mining company based out of South Africa. In fact, if I remember correctly, Sibanye Stillwater might be the largest producer of platinum, second largest producer of palladium, and the third largest gold producer in the world. Yet Sibanye Stillwater hasn't been around all that long. And Stillwater name comes from a gold mining company in Montana. I think there might have been a bit of a merger between Sibanye and Stillwater, hence the name Sibanye Stillwater. Anyway, this company, which is listed on the South African Exchange and also listed on the New York Stock Exchange, was or is the largest shareholder in New Century Resources with an interest of 19.9% after participating in equity raising in December 2021. However, they're not happy with management, and they have or are undergoing a potential takeover of the company because they think they can do a better job than the current New Century Resources Management. So this is some of the quotes they have or did use in their takeover announcement. So, for instance, Sibanye-Stillwater has been concerned about the change in strategic direction of the New Century under current management, with the building of tailings asset management services business no longer a focus. The substantial decline in shareholder value, with the New Century share price down 59% over the last 6 months, implies that the current strategy has not been well received by shareholders and investors. We have expressed our concerns directly to the board and did not want to support the proposed re-election of Nick Sonata or Robert McDonald to the board at the AGM on the 9th of November 2022. Sibanye-Stillwater further considers that New Century's balance sheet is under strain due to amortization requirements of the environmental bond facility and potential fund requirements for growth projects. Accordingly, New Century may need to raise additional equity, which could result in a material dilution for existing New Century shareholders, particularly given the New Century's current share price. And they've also mentioned that Sibanye-Stillwater has also recently become aware, including from public filings and trading on the ASX, that a number of shareholders in New Century may be looking to dispose of their holdings on the market despite limited trading liquidity on the ASX. So I think Sibanye-Stillwater is concerned about the direction of the company. They're not really liking the current management, and they believe they can do a better job. Hence, they want to take over this company. Share price popped up 42% because the current takeover bid is at $1.10. The current share price is $1.14. So there is that potential of maybe a competing bid. I think that's unlikely at this point in time. And I think there is a good chance this will go through because current shareholders are simply not happy with New Century Resources Management. And this is an out for that management to get rid of this company so they don't have to deal with current shareholders' dislike in them. Next company I want to talk about is Avita Medical, and this company did release their full-year results. Now, I think revenue was only up 4%, and this company is loss-making, but it wasn't really the results that really excited the market, because when they released their results, the share price rose 20%. You can see the share price in the chart has moved into an uptrend after being in a downtrend for a long period of time. In fact, this uptrend really began towards the end of last year, and the share price has more than doubled from its lows we saw back in June. So the share price has increased from $1.30 to a current share price of $3.16. So why was the market excited about these results? Well, here is a quote from the CEO, Jim Corbett, and just reading this quote has me excited about this company, particularly about the future growth this company might see, not only in the next few years, but simply this current financial year. So looking ahead, 2023 is our year of inflection. I'm always looking for inflection points for the company. So it's interesting to see that the CEO has used that word inflection. So he knows there are investors out there who are looking for inflection points. He goes on, we expect FDA approvals in June 2023 for our soft tissue repair and vitiligo indications, which we believe will be transformative for our company. He goes on and on, very, very bullish. So we expect to more than double our existing field sales organization, which will cover both burn and soft tissue accounts. This strategic expansion sets us on a path of revenue growth for the next 3 to 5 years. And this is why the market is right now excited about Avita Medical. That's why the share price rose 20% when they saw this particular quote, because the results, only 4% rise in revenue. I think the market is very bullish about, and the CEO is very bullish about the future of Avita Medical, not only in the next 5 years, but also just this particular financial year. From the sublime to the what the heck is happening to a company called Cogstate, because we have seen the share price decrease in 3 successive trading days. Now, Cogstate was in trading halt for a couple of days, but on the 20th of February, share price of Cogstate fell 18% on no news. Then on the 21st, it fell another 14.5%. And then they came out of trading update after a business update and financial year 23 guidance, and the share price fell 27%. So the very fact that they went into trading halt and they released a business update and updated the financial year 23 guidance, and the share price had dropped about 30%, maybe even 35%, the 2 days preceding the business update has me thinking right now there were some people who knew about this particular announcement that was upcoming for Cogstate, and they were selling. So that is illegal to be selling out of a company's shares if you know information that the rest of the market doesn't know. So that would be insider trading, the very definition of insider trading. So they went into a trading halt on the 21st of February at about 1:08 p.m. So shares were not able to be traded. That was on the second day the share price was decreasing. And then they came out on the 24th of February with that business update and financial year 23 guidance. Now, when I had a look at this particular business update and this financial year 23 guidance, so they don't expect financial year 23 to be as good as they expected. But here is a little quote from the particular commentary of this announcement. For context, at the 1st of July 2022, Cogstate had contracted future revenue of 139.1 million, of which it expected 29.7 million to be recognized as revenue in financial year 23. Cogstate now expects approximately 5 million of that financial year 23 contracted revenue to be recognized in financial year 24, and the remainder expected to impact second half of financial year 23. So for some reason, the market has reacted negatively, even though the only reason why they have decreased their guidance for financial year 23 is because some of the revenue they expected in this year will fall in next year. And that's not a reason to sell down your shares. Now, I also read that there was a possible takeover of this company, and that has fallen through. So a lot of things happening with Cogstate, and the very fact that the share price has absolutely fallen off a cliff. In fact, the share price has fallen, if I have a look at this, from about $2.30 to $1.18. So the share price has almost halved in 3 trading days. Now, if you look at the longer term picture here, so this is the chart going back to the end of 2021. The share price back in September actually fell to these levels, but the share price is now lower than those lows we saw back in August. So a lot of negative sentiment around this company, but I think there might be a little bit of buying simply because this company is profitable and this company is growing. So I think there will be investors out there who see this as a potential time to take a position in this company, particularly those investors who have been tracking and have put Cogstate on their watch list, who might see good value at current prices. And I'm one of those shareholders. However, just the negative sentiment in this company right now has me thinking I just stay clear for a little bit of time just to see, or just to make sure all those negative answers right now in the market who want to sell their Cogstate shares have had their chance to sell out. And we might continue to see selling over the next few trading days. For those who don't know, Step One, they manufacture, design, sell underwear. I'm pretty sure it's online underwear. So if you do need underwear and you're really looking for some good quality underwear, maybe Step One is the type of underwear for you. Now, I actually did have a look at a video the CEO did about a year ago, and it was talking about going for runs or something like that, going for hikes, and there was no useful underwear out there. So that's why he decided to develop some underwear that was useful for those people who are a little bit more active. Hence, Step One was born. However, it was an absolute shocker after they did list on the ASX. Share price fell a lot. In fact, on the 16th of May, 2022, share price fell 56% in 1 day. So more than likely, it was some negative news. And just before that day, the share price had absolutely collapsed. So the market was not really interested in this company back then, and they were selling off. They thought there was going to be some bad news coming through from the company, and there was bad news. But that was a low in the share price. So the low in Step One was on that day, 16th of May, 2022, when the share price got as low as 20.5 cents. But since then, the share price has been going sideways. It's been consolidating. And then the company did release the half-year results, and the share price rebounded 18% on the back of those results. So maybe all the bad news is through with step one, and you just see the chart. Does look like the share price is trying to break out. In fact, the share price has moved to a nice little resistance level, and that resistance level have been or is the highs we have seen since the 16th of May 2022, and that level is around about 37.5 cents. And the share price has tried to get above that level in the last 3 trading days, but has struggled. So if the share price gets above 37.5 cents, that would be good news for step one and the share price moving forward from here. So at this point in time, I have not much interest in step one. I'm not really sure about the business model, that sort of thing. But if you think there is some good value with this company at current valuations, maybe now is the time to get interested and excited about this company. Twice in the past month, I have seen a chart that I did get a little bit excited about. And after looking at the company and realizing the company or the fund manager, whatever it is, was a low quality company, I decided not to take a position, even though the chart was looking really interesting. And both times it has worked really well, because both of those companies, A&P and Platinuum Asset Management, released their half-year results, and the share price absolutely tanked. You can just see the chart for Platinuum Asset Management, well-defined downtrend up until towards the end of 2022. You can see the share price starting to rise in January of this year. In fact, the share price rose from $1.75 to $2.31 in about a month and a half. Then the company released their half-year results, and these were not good results. In fact, the share price was down 17% on those results and actually fell another 4 or 5% the next day as well. And this uptrend or potential uptrend in Platinuum Asset Management share price has come to an end. So that other company, A&P, saw a significant decrease in their share price on half-year results, even though the chart was looking bullish. And this is another example where the quality of a company is quite important. So even though the chart was looking bullish, the one reason I stayed clear of both these companies is just the quality of the company. And you probably could say the market got both of those companies wrong, A&P and Platinuum Asset Management. I'm not sure why I got it wrong. Don't know why the market thought their half-year results were going to be good, because they were not good. And that's why the share price absolutely tanked. Now onto some interesting trading we have seen on the market in regards to the market reaction after supposed good news. And the first company is Magnis Energy Technologies. Now, if you look at the longer term chart here, going back to the end of 2021, share price has really done nothing. No uptrend, no downtrend. Really, share price is going sideways. So at this point in time, if you are trading, the one sort of company you want to stay clear of is that company where the share price is not trending up or down. And that is definitely true for Magnis Energy Technologies. But they did announce an offtake agreement with Tesla on February 21. And you would think the share price would pop up. And it did. In fact, on open, the share price was up 25%. In fact, the share price went from 40 cents to 50 cents within the first few minutes of trading. But a lot of selling came in during that day, and the share price actually closed at 42 cents. So only up about 5% for the day. But over the next 3 trading days, the share price kept on falling. So a lot more sellers came in, more than likely, and this is just my thoughts around what caused the share price to decrease next 3 days, is just day traders got absolutely burned on February 21st because they saw this announcement, bought on open or near enough to open. So they bought around 50 cents. And then when the selling came in, they had these shares they didn't want to have anymore at a loss, and they kept on selling. And that's why the share price has dropped to 36.5 cents, which is significantly lower than the share price was before the announcement of this offtake agreement with Tesla. So this is just interesting trading. And I think it is being driven by day traders or short-term traders who are getting out of a position, an unideal position, that they absolutely gone wrong on February 21st. And just like Magnis Energy, this has been an interesting ride for MoneyMe. They provided a positive trading update on the 31st of January. And not only was it positive, this company is profitable. I think there are also other things that were really positive in that particular announcement. But the main thing is they are profitable, and they reacted really well to this changing environment we have seen in the past year. Many other unprofitable companies haven't reacted quickly or well, but you can't say that in regards to MoneyMe and their management. They have reacted, and they're now profitable. And as you expect, when a company releases a positive trading update to announce they are profitable, the share price rallied. In fact, the share price rose 64% on the 31st of January. In fact, the share price rose from 28 cents to 46 cents. So just again, it started the day or finished the previous day at 28 cents. But then some interesting things happened. So even though that was a really bullish one-day counterstick on the 31st of January, a lot of selling came in. And then during February, this is the share price decreases on each day. 6.5%, 11.6%, 8%, 7%, 1.5%, 6%, 5%, 5%, 4%, 0%, 4%, 2%, 2%. Then it was up 4% on the 20th of February, and then down 4%, 2%, 4%, 2%. So since this positive trading update, the MoneyMe share price has fallen all except 2 days. And one day it was neutral, it was sideways. And on one day, it was up 4% on the 20th of February. And the share price right now is at 22 cents. So remember, the day before that positive trading update, share price was 28 cents. So the share price has dropped 25% from the day or the previous day to the announcement, the positive announcement. And this is just the effect of day traders again getting burned. Not only day traders getting burned, there's probably a lot of investors who have bought into MoneyMe over the past few years at much higher prices because the share price of this company has fallen something like 80% in the past year, who saw the opportunity to get out when the share price rose on the 31st of January. And then when they saw the share price dropping, they just had to sell. So a lot of selling pressure after this positive trading update. And now I am closely looking at this company and potentially taking a position. But I'm just concerned that every single day, the share price decreases by another 2 to 4%. So at some point in time, this selling has to stop. I thought it would have stopped around 28 cents because that was a share price the day before they released this positive trading update, but it just keeps on falling. Over the past few years, I've always wondered about Australian ethical funds and why people are putting their money into this fund manager just because it's got the word ethical in it. Yes, that's true. Also know some people who bought into Australian ethical fund just because they thought this was a thematic, that people will continue to pile their money into ethical funds and they thought the share price will keep on going up. Well, that sort of thematic has really failed over the past, we'll say 14, 15 months, because the share price in November 2021 reached a high of about $15. The current share price of this fund is $3.55. Now, if you go back to November 2021, this was completely overvalued. I'm not sure why anyone was buying Australian ethical funds at that point in time. All you had to look was some, valuation metrics around this fund, and you'd be crazy to buy. But they thought people would keep on piling their money into this fund because it had the word ethical in it. And the share price just keeps on decreasing. Now, really interesting happenings occurred with the trading of this company over the last 3 trading days. So on the day they released their half-year results, the share price was only down 0.8%. Then on the next 2 days, on the Thursday and the Friday, the share price fell 6% and 8%. So there was some sort of delayed reaction from the market in terms of the reaction from the half-year results. And I have seen this with a few companies where the reaction has been delayed by 1 or 2 days. I can think of at least 2 other companies where there was not much reaction on the day they released the half-year results, and then the reaction came in the next 2 trading days. One of those companies was Mass Group, and there was another company I can't remember now. So the share price for Australian ethical funds is at $3.55. And the last time the share price was this low was way back in like 2020, 2019. So a well-defined downtrend, and the share price, it keeps on going down for this ethical fund. Now on to the 2 law companies. I'm not a big fan of investing in these sort of professional type companies like lawyers, accountants, that sort of thing. In my opinion, they should be private. And it's understandable why there's not much interest in the market around these companies. There was interest in Slater Gordon about 6, 7, 8, 9 years ago before they made that disastrous acquisition of, I think it was called Quindell in UK. If you look at a chart, if you go to TradingView, look at the chart of Slater Gordon, and you look at the chart or the share price back in 2014-15, you'd think the share price was something like $7,000. But because of this failed acquisition, there was a lot of dilution. And the share price wasn't that much back then. They just had to do a consolidation of the shares. Anyway, the company did release half-year results on the last trading day of the week, the Friday, and the share price rose 8%. Not only that, the valuation of this company is intriguing. So the market cap is around $80 million, yet the company was profitable, cash flow positive, that sort of thing, but just a lot of maintained negative sentiment around this company. Also, the CEO was quite bullish about turning things around, and the path of turning things around is definitely there. But I think all that negative sentiment that has just remained with this company since about 6, 7 years ago in relation to that failed acquisition, I think is still there. That's why this company is looking intriguing at current valuations. And on the flip side of Slater Gordon, whose share price rose 6% on the half-year results, we have Shine Justice. I think at one point in time they were called Shine Lawyers. I could be mistaken. But their share price did the complete opposite. In actual fact, it fell 18% on the day they released the results and another 4% the day after, which would be the Friday. In fact, the share price is now down to 72 cents. Just like Slater Gordon, I am getting a little bit not interested in this company, but a little bit more intrigued by where the share price is fallen. And I'll show you the weekly chart for Shine Justice in the next slide. But the share price is going down and has dropped a lot over the past about 3 or 4 months. So if we go back to September last year, the share price was almost $1.30. So the share price hasn't quite halved. In fact, it has halved from the highs we saw in November 2021. But I'm not sure. I haven't looked at these results just yet, but they were negative. And we know they're negative just based off the reaction from the market. But I'm becoming interested in taking a closer look at Shine Justice just because of where the share price is right now compared to historical lows. So if we have, and to show you the historical lows, we have to go back to 2016, 2018, because the share price of this company dropped a lot in January of 2016. And this was on the back of all these troubles with Slater & Gordon's acquisition, disastrous acquisition of Quindell. So let's have a look at the longer term chart for Shine Justice. So this is the daily or the weekly chart for Shine Justice going all the way back to the end of 2015. Can't quite see it. You can see it here, but it's you can just see back in January 2016, the share price, start of January 2016, the share price was around about $2. And then some disastrous numbers came in for the company. Can't remember exactly why, but I do remember the share price dropping massively, 73%. In fact, the share price dropped all the way down to below 50 cents in that week. And actually, that was a time to buy because the share price has not gotten lower. We saw a massive recovery in the share price. In fact, the share price went from 50 cents back up to $1.50. So a three-bagger over the next 10 months. Then the share price fell off a cliff from October 2016 all the way through to June 2017. So around about 50 cents seems to be the low for this company. But over the past, we'll say 4 to 5 years, around about 62.5 cents is a low for this company. And the share price for Shine Justice is moving towards that longer term low at 62.5 cents. And if the share price falls below 62.5 cents, the next really strong support level is around about 50 cents or just below 50 cents. The lows we saw back in 2016 and again in 2017. That's all I have for this video, looking at 10 companies on the ASX whose share price is going in all weird and wonderful directions for all weird and wonderful reasons. If you have any questions about any company I have featured in today's video, potentially maybe you are loving the law companies, maybe you think you'd be crazy not to invest in Shine Justice or Slater & Gordon or Kelly Partners, whatever it's called, the accounting company. Those sort of companies are just not for me. And there are many reasons behind it, and I won't get into those reasons right now, but those companies are not for me. But the whole point of me doing this channel and doing these sort of videos is to share ideas with you. So just because it might not be the sort of companies I would invest in, doesn't mean it's not the sort of company you would not invest in. So hopefully, maybe one person will look at Shine Justice, look at Slater Gordon, and decide these are the companies for me. So if you have any questions, just leave those questions or thoughts, leave those thoughts in the comment section of this video. Otherwise, I am not a financial advisor. If you do need financial advice, make sure you seek out someone who is qualified and can speak to your own financial needs. That's it for this video. Have a good day. Bye.